Good morning. I'm Margot Cella with the Center for Audit Quality. Today, we're going to be talking about the future of ESG reporting and assurance around those disclosures. I have with me today Jim Burton and Taylor Harris, who will introduce themselves in just a moment. But I wanted to go over a little bit of what we're going to be talking about. ESG-related matters are gaining significant attention from investors, regulators, as well as other stakeholders. In the last few years, this attention has been accelerated by several events: extreme weather and climate change, societal factors, large institutional investors such as BlackRock and State Street, and now a flurry of regulatory activity. Because of these forces, there is a movement towards achieving some consistency around these disclosures. Back in November, the IFRS Foundation announced the formation of the International Sustainability Standards Board, or the ISSB. They also released a couple of exposure drafts at the end of March. Also in March, the SEC proposed rules to enhance disclosure of climate-related risks, and they're considering expanding human capital management and board diversity disclosures. We're going to explore the current and future of ESG reporting and assurance landscape and the challenges the evolving landscape may pose for companies. So Jim, I'm going to ask you to introduce yourself.
Thanks, Margot. Hi, everyone. I'm Jim Burton. I am the partner in charge of sustainability and ESG services at Grant Thornton, and also the chair of the AICPA's Assurance Services Executive Committee, which is the committee at the AICPA that handles sustainability-related matters relevant to reporting and consulting. I'm glad to be here today. It's that awkward time of day where I don't know whether to say good morning or good afternoon for folks, but hope everybody is having a great April 21st.
And Taylor?
Thanks, Margot. I'm Taylor Harris. I am the Professional Practice Fellow at the Center for Audit Quality. I spend most of my time dealing with audit quality matters, focused on ESG, cybersecurity, things of that nature, and I'm really looking forward to our discussion today.
So great, thanks. So we will be taking questions and we'll address them as they come in, and we'll leave some for the end as well. But Jim, I'm going to start with you. There are different ESG frameworks and standards that are available for companies to use as they consider which ESG information to disclose. Can you just give us an overview of the current landscape? What are the standards, the frameworks, and how they differ?
Sure. And today our audience is ethics and compliance officers, and I'm sure that most of them have seen the alphabet soup that is the disclosure frameworks. Over the past decade, a number of disclosure frameworks and guidelines were created to meet individual requirements or expectations or desires of various interest groups. And as those were adopted, in a variety of ways, both globally and here in the US, one of the big complaints, and we'll talk about this earlier, was I don't know what, which framework to use or what I should be disclosing. Fortunately, today, those are beginning to consolidate a little bit, but the principal frameworks that are in use are the SASB standards, which are currently under the Value Reporting Foundation, currently, the GRI standards, TCFD recommendations for climate-related disclosures, and then a lot of entities report under CDP, the Carbon Disclosure Project, which gathers principally greenhouse gas information and rates entities on their performance with respect to those. So, they're very complementary frameworks in terms of what they look at, and they are used in a variety of different ways by entities. I will tell you, though, that I was recently at a conference, and a head of ESG for a private equity firm that's got a number of portfolio companies indicated that they were currently collecting 160 different metrics related to ESG from all of their portfolio companies. And she self-stated that that is probably way too many. And a lot of them were because it had just come from a variety of different places as people were gathering the information. The frameworks and the guidelines were the same way, a lot of things out there. And as we'll talk about a little bit moving forward, there's some consolidation occurring and some collaborating going on across those organizations to reduce that and hopefully come up with a lot more comparable and consistent information that entities can report under.
Thanks. So Taylor, IFAC, which is the International Federation of Accountants, published a report last June, I believe it was, that looked at 22 different jurisdictions, 1,400 companies, trying to assess the rate of disclosure for ESG information. Can you give us a little bit of an overview of what that study found? And I will mention before you give the answer to our audience that there are some slides in our session files that you can use where this data are. So Taylor, go ahead.
Sure. So I think something interesting that study found, the report found, was that just under 1,300, I think it was 1,269 companies disclosed ESG data out of that 1,400 set of companies surveyed and inspected. So it's a fairly significant quantity. Nearly 70% of those companies use multiple standards as well, with GRI being the most commonly used, followed by the UN's Sustainability Development Goals. So it's a component of the alphabet soup, which I'm referring to.
Great. And then the CAQ conducted an analysis of the S&P 500 companies to see what was happening there in terms of ESG disclosures. Can you give us an overview of those findings?
Yeah, absolutely. So to give a little background here, the CAQ did some research and analysis looking at the most recent publicly available ESG data for S&P 500 companies, and this was as of mid-June 2021. More information can be found on the CAQ's website, about this reporting and our findings. But what I would highlight is that CDP, the Carbon Disclosure Project, was the most frequently mentioned framework or standard, with 371 references across this group of firms. Only 10 companies referenced 5 frameworks or standards, these being GRI, SASB, TCFD, CDP, and IR. However, 146 companies referenced 4 of the 5 standards or frameworks. And I find this particularly interesting because it goes to show that many of these standards or frameworks are complementary or interoperable to a degree. 41 companies didn't reference any frameworks or standards, which I suppose is also, interesting and of note.
Yeah. So Jim, as you mentioned, there were some developments about some consolidation. Can you give us a little bit of background on the IFRS's announcement back in November, and then the launch of its consultation on its first 2 proposed standards that came out last month? What's the ultimate goal?
Yeah, so Margot, the ultimate goal here is to ease the burden for preparers and reporters on having to evaluate multiple frameworks, and all of the entities have a very similar mission, which is to provide the stakeholders with information. And historically, companies have focused on reporting and data disclosure principally for investors and lenders, and shareholders who have had a direct financial interest in the company. And the concept of stakeholder capitalism has grown significantly in the last several years, and all of these frameworks were focused on that. And while they may have to some extent competed in the market, none of them were competing from that traditional capital marketplace perspective. They were trying to provide the best information possible to the interest groups and the stakeholders on the subject matter that they had issued. And back in November, around the COP26 conference, a number of these entities announced collaboration and merger consolidation agreements, where the IRC merged with SASB to form the Value Reporting Foundation, and the Value Reporting Foundation agreed to merge with the IFRS Foundation and form the ISSB, and collaborate with the CDBP and WXYZ, and they're all getting together, right? But the point and the goal is the same, is let's get information available to our stakeholders in a way that allows people to better understand the information and how entities are managing and operating their risks relative to ESG and sustainability matters.
And can you talk a little bit about where these ESG disclosures commonly are found?
Well, I think that when we think about ESG disclosures and we immediately run to public company related items, private companies disclose as well. And the one commonality between public and private companies with respect to where they disclose is anywhere but in a public filing. The vast majority, 90-something% of the disclosures that are made in either a standalone sustainability report or on a website where they include information on policies, mission, objectives, and some of them include tables on data. Some of them are very explanatory documents, qualitative information. And the reason that no one is currently disclosing in the public filings is there's a lot of confusion and questions about how do securities laws relate to those disclosures and what's management held to, which set of liability might be undertaken. And as we get to talking here a little bit about the SEC proposal, that helped clarify a little bit of that in terms of what areas have safe harbors and are covered by disclosure, forward-looking statement related protections. But I do think that what is going to happen here coming forward is there's going to be some duplication of disclosures. There'll be disclosures in public company filings related to climate matters. And I can't see issuers excluding that information from a comprehensive sustainability report, because it ties into the company's overall strategy on how these matters affect the entity. And so I think that you're going to have information now coming out in two places once the SEC's rule comes into effect.
Yeah, and maybe even three if they also put things separately on their websites for different issues. So one thing about ESG disclosures is that they're not always, there's often a question that maybe it's not reliable. Taylor, the IFAC report highlighted what some of the largest companies did in terms of getting assurance around their disclosures, I know, to demonstrate to their investors and other statement users, that's reliable and valid. So can you give us an overview of what the percentages of companies are that seek assurance around their disclosures?
Sure, and for folks in the audience, you can look on slide 4 here for some more detailed information, but I'll hit some of the highlights. So of these 22 countries who are surveyed in this report, the vast majority of those countries had 90% or more of their largest companies disclosing ESG information. And you'll see that the percent of those that sought out assurance on one or more of their ESG disclosures, it does vary greatly. There are some countries who are doing really well with assurance, some not so much. France and Spain, for example, do lead the way with 96 and 79% of their largest companies getting some level of assurance. You'll see the US is also not far behind, which is good to see. And of those companies that seek assurance in France and Spain, the vast majority of those are actually choosing an audit firm to be their assurance provider. Assurance over ESG information is required in both France and Spain, so that is of note. But the provider of that assurance just has to be an independent third party, not necessarily an auditor.
Interesting. Okay. And then we also analyzed the CAQ, the S&P 500, and it was a slightly different results. Can you tell us what we found in terms of assurance for ESG matters in the S&P 500?
Yeah, I'm happy to. It's a little bit of a different lens, right? Looking at the S&P 500. So if you parse that out into the S&P 100, sort of up at the top there, 82% of those companies had some level of assurance or verification over their ESG disclosure information. And then if you parse it down to the next 400 to round out the 5, only 46% of those companies had assurance over their ESG information or components of it. And the vast majority of that assurance was over greenhouse gas emission information.
Yeah, so Jim, in the IFAC report, it looked like the auditor is commonly engaged to provide assurance in the ESG reporting. I know you're an auditor, so maybe you could tell us why you think auditors are in the best position to provide assurance.
Well, I think that report pointed out that on a global basis, financial statement auditors are providing that, and in the U.S., it's actually a little bit reversed right now in terms of the number of entities where the financial statement auditor is also providing the assurance over the sustainability disclosures. And I think we need to understand how it got that way in the US. A lot of the audit requirements that are laid out on a global basis, particularly in Europe, are regulatory and driven through the legislative process. And it kind of naturally went to the organizations that are covered by similar regulation and are inspected and have a process. Whereas in the US, because we don't have as precise or robust a regulatory environment over sustainability reporting, the progression over the last decade was, hey, let's disclose some information with respect to our sustainability matters and how we're managing that. And that was pushed out to the operations group or the marketing group or investor relations, who have relationships with others. And Taylor pointed out that the number one item that's getting assurance is greenhouse gases. So most of that was coming from operations. Mm-hmm. And the operations people reached out to the vendor base and the supplier base that they're used to working with. It's a lot of contractors, consultants, environmental engineering specialists, and they helped them gather that information and get it ready and to put it in a way that it could be reported. And then he started reporting it. And the next phase that comes from when you start reporting and people are using the information is, how reliable is that information? And is it more valuable if it's reliable? And I think we all agree that, information that is viewed as reliable is more valuable information than information that's not. And so they started to seek out assurance over that. And they already had a group of people who were included in that process of gathering it. And they said, hey, can you provide a level of assurance over this, or let people know that this just isn't the people in the company writing down numbers on the back of the napkin and saying, hey, these are our greenhouse gas emissions. You're a reputable engineering and consulting firm. Can you, tell people that you were involved and how you were involved? And that's evolved. Right. And so that's how we ended up with so many entities getting assurance over their information from non-audit firms in the US. You mentioned that I am an auditor. I am a CPA, and I work for a large firm that provides assurance over information. So I might be a little biased here. But I do think that things are going to evolve to where more of the existing financial statement auditor will be providing a larger percentage of assurance going forward. And that's for a variety of reasons. There's a very formal structure of independence, system of quality control, the due process that the frameworks under which the assurance is provided run through, very much the way they are with financial statements. And so the market can come to expect and understand what that assurance report means and the comparability of those across all of the entities. So I do believe that is an element that's going to drive, one of the elements that's going to drive the assurance to CPA firms. I think the second one is that in the history of reporting of anything, at some point somebody decides there's a benefit or a reason or an incentive to misreport that information. And the nasty 5-letter word of fraud. And we've seen it in the ESG space. There's some very classic cases. One of the largest ones out there that everybody's aware of is Volkswagen. I actually saw a commercial on TV last night about an electric vehicle company that talked about no Dieselgate in the ad, and I think we all know what they're referring to there. And what you have here is that somebody is going to misreport. And when that happens, there's going to be calls from the stakeholder groups and the investor groups on where were the auditors? Why was this information not caught by someone? And that's going to accelerate the amount of existing assurance that's obtained. And the audit firms are in the best position to address things with that fraud lens, because we apply that fraud lens constantly in the financial reporting process. And then I think lastly that you're going to end up with is, as the external driver, is that financial statement auditors and auditors are constantly used to using qualified specialists in the audit process to contribute evidence and information to that validation and the conclusion that the information is reliable. And climate-related disclosures and sustainability disclosures do entail the use of a variety of different areas of expertise. And so I think the auditor's existing skill set on bringing that together to conclude on the appropriateness of the presentation is key. I also think there's going to be a desire from the people who are reporting it that the financial statement auditor is already very well aware of the systems, the information flows, and all of the different elements of the entity that contribute to concluding whether or not that information is accurate and reliable. And as a result, there will be a benefit from the reporting company's perspective and the preparer's perspective on being more efficient in the oversight process. And I know that we've had some conversations with audit committees who are asking those types of questions today. How do I, best conclude that this information is reliable? And connecting it to our audience today, right? There definitely will be a shared responsibility between management, the internal audit and compliance groups, kind of that, what are the second and third lines of defense, and the external auditor in delivering reliability.
And I should mention, you kind of made the point, but I want to drive it home that if the external auditor who's doing the financial statement audit is also doing assurance around any of the ESG measures, that activity is still under the requirements of the PCAOB auditing standards. So it's, am I correct there?
Yeah, where the disclosures will be, particularly with the SEC's proposed climate change information, those disclosures will be in the financials, in a document that contains the financial statements. So the auditor will be reading those and assessing it for consistency with the basis on which the financial statements were prepared and the disclosures there. And when you think about some of the new disclosures that have been proposed by the SEC and the information and how it connects to the financial statements, if there was someone other than the financial statement auditor providing that assurance, there is an opportunity for duplication of effort.
Yeah. So you alluded earlier to private companies, and we've been talking mostly about public, but these ESG disclosures also will impact, and assurance would impact private companies. Can you give us an overview of that situation?
Yeah, so if we go back to, why have these disclosures started in the first place, right? It was investors and other stakeholder groups, participants in the value chain asking for this information. It wasn't the legislation or the regulations coming out and saying, hey, we've got a great idea. Let's disclose all these things with respect to climate and human capital and other sustainability related topics. It was the stakeholders asking for that. And so that stakeholder request is not limited to public companies. It's what industry are you in? It's where do you sit in my value chain? It's employees looking at their potential employers for what is this brand about? What is this entity about? And how does that information tie into the company's overall messaging? So those same business imperatives exist for private companies as well as public companies. The public companies are clearly getting pushed a little bit harder because that information is used so much more frequently in the marketplace. But private entities who are part of the value chain of public companies will be asked for this information, and they are currently being asked for it by all of the market participants and lenders. You can't go a day without seeing in the Wall Street Journal or in a various news blog where financial institutions have talked about their financed emission measurements, how they're thinking about sustainability related metrics. And we're seeing them begin to incorporate those types of elements as not restrictive or covenants within loans, but as opportunities within lending agreements for entities to tackle climate related and other sustainability DE&I elements and have that be a positive factor to the lending component. So cost of capital is affected by these disclosures, and anyone who's participating there is seeking information. So private companies are going to need to report and have this information available no differently than public companies are. It's just where they're going to provide it to and the timelines will be a little bit different.
Yeah, I know, having looked at some of the academic research, that there's a few studies that show that companies, public or private, that have assurance around any of their ESG, particularly their climate, seem to have a easier walk to getting good capital deals, capital financing deals. We've been talking about the SEC's proposed climate disclosure rule. What do you see as the important considerations for the SEC as it moves forward?
Well, what I don't want this to be is to be another session on let's digest and break down the SEC's proposal. I think every entity that has any connection to these topics has sent out a summary of it, and then I think everybody's aware of, what it contains: qualitative disclosures around strategy and management of climate matters, quantitative disclosures of emissions information, footnote disclosures of financial impacts and assurance. But I think there's a few key items that we should consider here, right? And people should be aware of, particularly the ethics and compliance officers, as to how this fits in to what they are looking at, right? First off, the SEC's proposal has a focus on the financial control of the company, not necessarily operational control that the greenhouse gas protocol focuses on. So some entities may experience some differences between the measurements that they're making currently and the measurements that they would make, which entities and which operations are included in that. I think most people do understand the financial control model. There's literally thousands of pages on what should be consolidated and included out there. And so the SEC had some good ideas in following that, because it's very consistent to what entities are used to. But managing that change from how you measured it before to how you might be measuring and reporting it now will require a little bit of focus. I think second, comparative information is interesting. The SEC proposal talks about if you have it available and if it's practical to obtain, and they cited in their basis for issuing the proposal the number and percentages of entities that are already making these disclosures. I think that there's going to be some interesting dialogues that occur in this process as entities are beginning to report this and they start thinking about comparative information. And I have a standing $100 bet with members of my team that there will be at least one conversation that goes something like, I don't think we should disclose the prior year numbers. It turns out they're not as accurate as we thought they were. Nobody's taken me up on that bet yet. And whether or not that's already a problem from a securities law perspective, because the information was out there, even though it wasn't covered by that, and so I think that, the internal audit groups, the compliance officers can help right now getting into that information and seeing, are we going to have problems with our prior information? Because there's clearly an expectation that even though it might not need to be covered by the assurance requirements and everything else, that information will continue to be reported. And I think there's going to be some focus on that. The new financial statement footnote is going to require some attention. It's intended to be covered by disclosure controls and procedures, as well as ICFR, because it's in the footnotes. And whether that stands to stay at the 1% threshold that's proposed or not. I know there'll be a lot of comments on that threshold, but if you think about a 1% threshold in your ICFR, clearly a lot of areas of ICFR are not focused on that level of precision. And because this covers the entire set of financial statements, it's not as if it's just one particular area that you would have to have a little bit sharper or more precise control over. It would affect your entire purchasing structure, your entire reporting structure, your management review controls. So, I do think that how that comes in. And I think that, I mentioned it a little bit earlier, the consistency of the disclosures between your external sustainability report and what you have in the 10K is going to be an area of focus. And I'm not even going to go into scope 3 and some of the challenges there, because scope 3 is its own animal, which will require, depending on what sector you're in and what industry you're in, how you conclude what's material and how you're going to go about measuring that. So there definitely is some activity. It's April 21st, less than 23 months from now under the current proposal, large accelerated filers will be reporting this information, and 23 months goes by fast. And we have been conditioned over the last, half decade to a decade that everything is deferred. I mean, I don't know if there's been a pronouncement that's come out in the last decade that hasn't had a deferral, right? And for a lot of good reasons or a lot of issues. And I do think people expect there'll be a deferral of this. And I'm not so sure that it's going to happen this time. Not because they're trying to send a message or whatever, but because the basis for this has been, you're already disclosing it. And while there will be a shift, it's never been disclosed under securities laws and it's never been included in here. So it's going to be new. I'm not suggesting it's going to be easy, but at the same time, every other stakeholder group has said, they're interested in this. Goldman put out something that says, we're not going to wait for the SEC. We're going to vote based on whether you are or are not making these disclosures. So regulation here is catching up. It's not establishing new territory. So I wouldn't plan on there being a delay.
Yeah. So we're about halfway through. I just want to encourage the audience to send in your questions. So Taylor, from a practitioner's perspective, what do you expect will be the impact of the SEC mandated disclosures on assurance of public company reported climate info?
Sure. So I guess my response will be predicated on, the proposed rule going ahead as written, right? And that's a little bit uncertain right now, of course. But the proposed new climate-related footnote that's included in the rule, included in the financial statements, would be subject to the audit of the financial statements. So that's definitely an assurance impact that you, would see. Jim also mentioned that there will be a myriad of other information included within the SEC's filings outside of the financial statements. And this other information, Jim mentioned auditors have a responsibility to read and consider whether it's materially, inconsistent or consistent with the information in the audited financial statements. But the auditor is not required to perform audit procedures or review procedures directly on other information, so including the climate-related information that would be included in there. Although I suppose there would be an exception, and that would relate to the Scope 1 and Scope 2 GHG emissions, the greenhouse gas emissions, and those would be subject to initially limited assurance, followed by reasonable assurance using a phase-in approach depending on filer status for certain companies. And just to maybe give a little bit of background about the limited and reasonable assurance aspects, firms can use, among other options, examination or review engagements under AICPA attestation standards. The review engagement under those standards could be used to provide limited assurance, and under that, practitioners would draw a conclusion about whether they're aware of any material modifications that should be made to ESG information in order for that information to be in accordance with the disclosure criteria. Whereas under an examination engagement, the objective would be to obtain reasonable assurance, which is not, it's high, but it's not absolute, assurance. And it would be used to express an opinion about whether that ESG information is in accordance with that criteria in all material respects. So looking back at a review engagement, it's substantially less in scope than an examination engagement, but it does result in meaningful, albeit lower level of assurance than examination. An examination engagement, a practitioner obtains the same level of assurance you would under a financial statement audit.
Okay.
And similarly, companies often do ask if your independent accounting firm who does your financial statement audit can also provide assurance over ESG information. And the answer to that is yes. It is a permissible service subject to pre-approval from the audit committee, and provided firms are meeting certain independence requirements. And we found within our S&P 500 analysis that of those firms who used accounting firms for their assurance services, about 80% used the same firm for both financial statement audits as well as their ESG information.
Yeah, interesting. Yeah, we all have to be very careful about that, since Sarbanes-Oxley, what's permissible and what's not a permissible service to be provided. So Jim, what will be the impact on company management, on our compliance and risk officers and others?
Well, those are two groups within the organization, right? So you've got management and you've got compliance and risk officers. I think focusing on the compliance and risk officers component is, I think you've got more work in front of you. I was having a conversation with a large Fortune 500 entity who's published a sustainability report for more than 10 years. So very well seasoned in terms of reporting, very, kind of best in class, excellent element. And their chief audit executive made the comment, no one on my team has ever looked at one disclosure in that report. Wow. And so, that's not saying it's wrong. It's not saying that, but there was never an external impetus to do that, right? They were focused on operational audits, on ICFR related matters, on other compliance areas. And now they're going to be incorporating that into their audit plan. And so that is a people requirement. It's a timeline requirement. It's a subject matter capability and expertise requirement. So all of those elements are going to be affecting compliance and risk officers in terms of how do I go about addressing these new disclosure requirements from the perspective of risk.
So Taylor, another challenge companies are going to face is determining the impact that these disclosures will have on the financial statements. So what are some of the key financial areas and considerations that the company should be thinking about when it comes to their climate risk?
It's a good question. And I think maybe before I dive into that too deeply, I'd want to give the audience an idea of, current state expectations. And so absent the proposed climate rule from the SEC and absent any explicit reference to climate-related risks within US GAAP, companies are currently required to consider climate-related risks when their effect could be reasonably be material to the financial statements. That's just sort of a current state requirement. The financial reporting requirements for physical and transition risks related to climate will, of course, vary from company to company and depends on a myriad of factors, the nature of a company's business, its industry, geographic footprint, things among other things. But ultimately, climate-related risks may directly affect amounts or disclosures within the financial statements, and those need to be considered. Others may indirectly affect the financial statements or may have a material impact. So, it's just something for folks to keep looking out for, regardless of what proceeds with these proposed rules. With that in mind, I can provide a couple of examples, perhaps, that might be useful for the group here.
That'd be great.
Oftentimes, you'll see companies disclose they're trying to reduce greenhouse gas emissions by changing out current manufacturing equipment for equipment that's more energy efficient, if it emits fewer greenhouse gases, things of that nature. With that comes, possible considerations for impairment of those assets. If you're going to dispose of them sooner than you originally expected, it impacts their useful life of that machinery. So when you think about that and maybe take it even a step further, that machinery could be sitting within a separate reporting unit that has its own goodwill. So if you're going to impair that machinery, it could affect the future cash flows of that reporting unit, and to the extent it would lower the profit margin or decrease sales, things of that nature. You might also have an impairment issue with that reporting unit itself. Another area you might see this in would be inventory. Customer demand is shifting a lot as it relates to things in the ESG space, not even just climate related, but other aspects. So to the extent consumer demand shifts, that could in fact impact your inventory obsolescence analyses. So these are just a couple of examples of financial statement areas that might be affected, although every company's circumstances are going to be a little bit different, particularly as it relates to climate related matters.
So Jim, I think I may have forgot to ask you about issues for companies in terms of the new SEC.
Yeah, Margot, I mean, we talked about risk managers and their perspective. I think again, looking at it from the risk manager's perspective in terms of what are they going to see the companies struggling with, right? The first line of defense, the management folks. First one is all about data, right? I mean, what we're talking about here in terms of the qualitative disclosures around risks and strategies and the approach, and the quantitative disclosures, both in the emissions related area, the financial impacts and the footnote, it's about where's the data coming from and what's the governance around that data, what processes are used to gather the information, and what's the level of precision that's used there. And there's a couple of really big keys. The number one ERP system for ESG reporting is Excel by far. And I think we all understand the challenges that Excel has with respect to security and accuracy, and all of the things that we went through over the last 2 decades with IT systems and IT security. Is we're going to relive it in the ESG space. So having risk and compliance officers get on people to understand how do you control that information. Not suggesting that everybody needs to go out and buy the new application or software tool that's necessary or that are available to capture and report ESG information, but definitely until that is done, there's going to be a need to focus on the completeness and accuracy and reliability of that information. And the precision of that information is also a challenge, right? The chief operating officer, the operations guy in the warehouse, they operate on a level of data and a precision that's a little bit different than financial reporting and now sustainability reporting. And so what they can use in terms of estimates and experience and how they make decisions on the operating floor based on certain pieces of information is a different level of precision that's necessary for something you're reporting external under the securities laws. So focusing on it from that perspective, I think is going to also be there. The staffing that you're going to need here, right? There is a technical knowledge. You do have to learn what the disclosures are. I mean, what is scope 1? What is scope 2? What is scope 3? How does that come into play? Not suggesting you need to hire climate scientists and meteorologists and trying to figure it all out, but you need an awareness of how those concepts do affect the information. And for something like scope 1, it's as much of a fixed asset audit as it is a scientific evaluation, because you need to make sure that if you do have greenhouse gas emitting equipment, that you've captured it all, that you've got a process to make sure that that information was included in the computation of what your greenhouse gas emissions are, and that those computations were applied consistently and appropriately. So you can see a lot of recalculation, a lot of looking at what and how the numbers were put together by management that they reported is there. And then one of the requirements in the SEC disclosure is whether or not you're using scenario analysis. And if you're using scenario analysis, they have a number of requirements that go into what you're supposed to disclose about that. I hope that this doesn't drive people away from scenario analysis, because if I don't do it, I don't have to disclose it. And I think that's a backwards philosophy, and I don't think that's what will be applied. But if there is scenario analysis being employed, risk and compliance officers are going to need to help management understand what goes into the inputs and the assumptions to that scenario. What are the sensitivities of that? And there's disclosures that are required as a result of that. And those disclosures are not just going to be focused on the scenario analysis, but they start to bleed into the financial statements on estimates and other elements that use forward-looking information. And that's been one of the big criticisms that's occurred in the marketplace regarding ESG and climate-related disclosures is, companies aren't disclosing how they're factoring all of these elements in. Whether or not the standards are supposed to be read to include every item on the shopping list that was included, I think is had a lot of different practice in terms of the application of that over time. But definitely the standards and what the SEC is proposing talk about including those disclosures. So getting behind that scenario analysis and understanding it from the risk perspective is important. And that scenario analysis, the output, it isn't just going to be for the reporting that's required from the SEC proposal. That's going to factor into the company's enterprise risk approach. and everything that they do from a risk assessment and long-term business planning, which affects your strategy. So, while some people think about these climate disclosures and everything, oh, it's a bolt-on, it's information that's not there. We've been dealing with changes in the business environment ever since business has been created. And climate is just another one of those changes in the business environment that companies need to deal with and address from their reporting perspective, right? Customer behaviors change, customer attitudes change. They've done that for hundreds of years for all kinds of things, and companies adapt to that. And I think they'll do the same thing here with climate. Some entities are directly affected. Energy companies, utility companies, automobile industry, right? They're directly affected, but others are indirect from that transition. And that's what these disclosures are trying to get at. And risk and compliance officers can play an important role to make sure that it's not just that first step immediate item that's being considered by companies, that it's the follow-on effects and what are the trickle-down effects, right? Moving away from climate and going to something like employee business, employee related matters. Many companies have disclosed on their website concepts around fair wages and how they manage their supply chain with respect to employee welfare related matters. But if your business model is I'm the low cost producer, right? That creates an inherent risk element that somewhere in your supply chain, maybe 2 or 3 phases removed, not your employees, right? But maybe your supplier is using child labor or underpaying or some of those risks that you read about. So I manage for that. Well, are you managing it far enough down your chain to where that's going to come back? So, and risk and compliance officers are right there to be able to provide this benefit.
Yeah. Well, we did get a question about how much companies would have to invest in like new tech platforms or whatever. I think you addressed some of that. But what I wanted to ask you about was, a lot of companies are coming out and making these net zero commitments by 2030 or 2050 or, some other year. I mean, I guess the question is, do we think these are actual commitments or are they just aspirational goals? And how do you ascertain what companies intend with these statements when they make them publicly?
Well, Taylor's been the one providing the statistics, but I'll do one here, right? I think 70%, I think there was a study that said people do not believe that 70% of the goals and commitments that have been made in the market lack substance. And so whether or not it's aspirational or real or everything, I think it's the substance that's what they're getting at, which is a company can set a mission and a focus for 2050 to say, my goal is to get here. There's nothing wrong with setting that. And in today's environment, it'd be strange for entities to not be thinking about what their commitment would be. It's the substance behind and what is it going to take to get there that's the real challenge, right? Because in some industries and in some locations, it's far more controllable to get there, to at least to a point. But every entity at some point gets dependent on the others in their value chain and technology advancements and what happens, in my real estate. Do I have enough access to real estate that's powered through renewable energy sources? And so there's going to be a dependency. And what those goals and what even some of the SEC proposals are and what many of the criticisms that are out there over the goals is it's getting at that substance. And so there is an expectation that there'll be more transparency about what those goals will take to get there in terms of business model changes, costs or investments. And even if it relates to technology expectations that aren't yet created, if that's a component, I think that there's an expectation that companies will make that statement and be transparent about it. I do know, I'm also not that naive, that there's going to be a whole lot of people in 2024 looking at each other's disclosures to say who's saying what, because that's not something that, there's a lot of companies out there that build their brand around their role in the sustainable economy. this is one that not a lot of financial reporting and risk and compliance officers are excited about being the first one to go out and say, I have no idea how I'm going to get to my goal in 2050. I'm really hoping that something comes along that allows me to handle it. So there's going to need to be a lot of discussion in the boardroom and in the reporting process over how you're going to include that.
Yeah, and I would say for those, that have 2030 as their end date, they haven't started already, it may be a little late to take.
Yeah, I mean, we haven't mentioned renewable energy credits and how those become offsets and that entire market, and a lot of people rely on those in order to meet their targets, and it's that's probably a whole nother conference on how credits and offsets play into this and what some of the challenges, benefits, risks, and opportunities are associated with them. But one of the SEC proposals, if you're using them, you need to have a discussion about how you're using them and how they factor in. So it's not just, okay, I'll lower from A to B and then I'll just cover the rest of it by buying some offsets.
Right.
It's not that easy. Yeah,
because if everybody's trying to buy those assets, there's only a limited number that can be used. So Taylor, I know we've talked about ESG disclosures that are mostly outside of the financial statements. And you sort of indicated a little bit earlier about what the auditor's responsibility was, but could you give us a little more color around what the auditor's responsibility is around information that's disclosed in these separate sustainability reports?
Sure. So to the extent that a company is disclosing climate-related information in a standalone ESG report, which I think, as Jim mentioned, today is how much of this information is being reported. In these instances, the auditor of the financial statements has no responsibility to the information in that separate report, technically. However, companies can and often do, as I've mentioned before, engage auditors to perform attestation engagements separate and apart from the financial statement audits to obtain limited or reasonable assurance on information in standalone ESG reports. So, again, it's possible, but.
Okay. And we have a few minutes left. Jim, how can the compliance and risk role prepare for these ESG mandates?
Well, I think we've covered a lot of it. And the question that did come through, about, what type of investment in tech infrastructure is necessary. I mentioned that Excel's used right now. Look, there's no entity that does its financial reporting without a tech infrastructure. Right. I mean, the amount of data and the amount of information that comes across, the ability to assess its reliability based on the controls and the capabilities and the consistency in that system is something that will benefit sustainability disclosure. So I do fully expect every entity to make an investment in a tech infrastructure over time. As they do that, a number of the ERP system providers have added things. A new application to help you report your emissions and other sustainability related information comes out every week because it's a market opportunity. So they're putting that out there. There's absolutely going to be an investment there because it's all about the data and the information. And think about how this is tying into the general uneasiness that's out there in the first place, right? We've been publishing financial statements for 100 years, right? I mean, they've been out there and they came out because back in 1933 and 34, somebody decided that too many people were ripping off people by not disclosing information, right? So the financial statements have got 100 years of experience on the information that's told in that document. And that tells the financial and economic affairs of the company. How did management deal with those? Nobody worries about publishing those. They worry about maybe what's in them, but they understand how they got to publish them. That's where we are today on sustainability disclosures. And it shouldn't have been surprising to anyone that people want this information because we're in the information society. I mean, everything we do is built around data and information. And basically what the stakeholders are asking is give me information so that I can help make my decisions with respect to how I want to interact with your company. And it feels uncomfortable because we've never had to open up the covers this much and provide this much data out there. And so, I do think that tech infrastructure is going to facilitate it. I do think that the risk and compliance officers are going to help entities feel more comfortable about making those disclosures and that it's reliable. And, whether or not you disclose it doesn't change the fact of what it actually is. So if you have, X level of carbon emissions, that's what you have. Whether you tell somebody or not, and how you deal with them is what you're going to do. You can't make it go away simply by not reporting it. So the reporting is really just acknowledging it and sharing it with other people who are interested in it. And everybody's favorite statement, you can't manage what you don't measure. And I do think that the tech infrastructure will help measure this to get not only the reporting requirements, but the strategic and operational synergies that can come from it.
Yeah. So now I'm going to throw you, maybe it's a slight curveball, because there's this other industry that has come about, the last, decade, 15 years, the ESG rating providers. So what impact might the potential regulatory changes have on that industry, on ratings of ESG metrics?
Taylor, you want to take that, or you want me to? How do you want to do that?
I'll defer to you and I can chime in.
Okay, well, I'll try to hit that curveball, Margot. Look, one of the things that we tell our clients is don't chase the rating agency, don't chase a better rating, right? Do what's important and what's necessary for your strategy, and report transparently and objectively with that information, and the ratings agencies will do what they're going to do with it. Credit rating agencies serve a purpose, right? They look at cash flow issues and cash flow risks, and it affects perception on whether or not an entity will be able to pay back its obligations or the notes that it's included there. ESG, we're still in that phase of it's both trying to influence behavior and determine which ones are relevant to long-term value creation and value maintenance. And so I think the rating agencies are going to continue to go through an evolutionary process that helps define the information that's relevant. So every entity should be aware of what the rating agencies are capturing and looking at, because they're only looking at the information that you provide them, whether you provide it to them in a standalone submission because they've asked for it, or they get it from what's available in the public domain. They're presenting that information and they're capturing it. So if your entity is not reporting information voluntarily on a website or through other means, they're filling in the blanks or basically suggesting that you've got nothing. And that's where a lot of the poor ratings come from. I think healthcare is one of the industries that doesn't report a lot in this currently. And a lot of the rating agencies give them really bad results, not because they're not doing anything, but because they don't report a lot. And as a result, the rating agencies say, well, then you must be bad. And there's not a correlation there. So the rating agencies serve a purpose. They're not always going to all come up with the same rating. I mean, look, stock analysts don't all come up with the same recommendations for what you should do with your shares. So you shouldn't expect the rating agencies to all do it the same. But understanding what the rating agency is focused on and the information that you're providing in it that influences that does help you align, your strategic and your operational decisions with how it's perceived in the market.
Taylor, anything to add there?
I think Tim knocked the curveball out of the park, actually.
So we have a home run. We only have now like a minute left. So I wanted to ask each of you for like a key takeaway, like what would you want the audience to focus on and to remember, tonight or tomorrow or next week when they think about what all they heard here today? Taylor, I think I'll start with you.
Sure. I think the biggest key takeaway, particularly for this audience, would be preparing early. I think Jim mentioned 23 odd months from now, folks will be reporting on this, things go as planned, right? So planning early, getting your key processes and controls in place, working with folks in your company, having transparent conversations on how to be transparent in disclosures, I think will behoove, everyone.
And Jim?
I think my piece of advice would be if this is viewed as a compliance exercise, so that it's just I'm doing it because I have to, and I'm going to report it, it's going to feel disconnected, it's going to be inefficient, and it's not going to get the level of buy-in and success that it could otherwise if it's integrated with the strategic and operational approach to the company. Risk and compliance officers lead risk assessment processes all the time that are completely interlinked with the company's strategy. This can be too. And 10 years from now, we probably won't call it ESG. We'll just call it business, because every one of these things are things we've dealt with forever and we've done it well. ESG is a label that helps us focus ourselves today.
Okay, great. Well, thank you. Good advice. Thank you both to Jim and Taylor, and thank you to the audience for your attention today.
Thank you.
Thanks, Margot.
Thank you.